Larry, in your analysis, are you expecting the correlation to hold and for us to see another massive surge in inflation to hit later this year and into 2025 and maybe 26?
I really am. I mean, I do think it's like the 70s. I mean, Tavi Costa's got some great charts on Twitter, that show that. I mean, each wave is a higher low and a higher high. There'll be a lot of cross currents, though, Gary, to be fair. I mean, if the economy is falling apart, that might, bring the prices of some things down. I like to think that what's going on, some of what's going to go on in this particular decade is it's going to be inflation in all the stuff you need and deflation in the stuff you own. The things that are financed by debt. I mean, I could actually see a case where, food and gasoline are getting more expensive, but housing prices actually fall, because we're in a recession, people have gotten levered up.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today, we're fortunate to have with us Larry Lepard. Larry founded Equity Management Associates in 2006. EMA is an equity investment management firm. Since 2008, EMA has focused on investing in companies which mine the monetary metals, gold and silver. Larry presently serves on the board of directors of two development stage gold mining companies, Lavris Gold and Rise Gold. He's been a frequent guest of many media outlets, including Bloomberg Television, for his expertise on the monetary metals market. Larry, thank you so much for joining us.
Oh,
today.
You're most welcome. Nice to join you, Gary. I've watched your show for a long time, so it's great to be with you.
I really appreciate that. Well, let's dive in. Let's begin with the most recent situation in the presidential race and how it affects the economy and markets. Does the attempt on former President Trump's life at his rally last week fundamentally change your view on the economy and markets, and if so, in what ways?
Yeah, not fundamentally. I mean, I think my views are pretty well set, but what a horrific thing and what a scary thing. What I think it kind of emphasizes, or the point that it builds upon, is that the country is broken and that, the government's incompetent. And I think there's going to be a recognition moment when everyone's going to realize how incompetent the government is, and that's going to have a big implication on the monetary metals. But very much in the same way that, everyone kind of knew Biden was losing it. And then we had a debate, and the whole world now knows Biden has lost it and he's a goner. We kind of think we have a system that's operating, and here we are, and we've got, and I'm not going to go into all the theories about who did it, but we've got guys shooting at a presidential candidate, and we've got just an enormously, incredibly either inept or corrupt, because they let it happen, Secret Service, either of which is terrible. And so, this country is broken and falling apart. And so I think it's an accelerant to the macro views that I have, but the views haven't changed at all. I mean, we're, macro-wise, we're in a tough spot, and this just emphasizes one more brick in the wall of a fourth turning, emphasizing what a tough spot we're in, right?
Well, why don't you dive into that fourth turning for a moment and share with us what your thoughts are and how the parallels to Neil Howe's fourth turning description is playing out today?
Yeah, I'll make it brief. I mean, a lot of people probably know this. A few don't. For those who don't, the fourth turning is a social model developed by Howe and Strauss and encapsulated in a book by the name of the same title, which, the bottom line of it all is it suggests that every 70 or 80 years, every kind of generation, long lifetime, things change. Things break, and then they have to change, and you have a new arisal of a new system that's a better system. And there have been three notable historical fourth turnings in the United States. The Depression in World War II was the last one. The world was a certain way before that. The world was a different way after that. The U.S. came out on the top of the world. Before that, the prior fourth turning was the Civil War. The U.S. was a certain way before the Civil War. It was a different way after the Civil War. And before that, the fourth turning was the American Revolution. We were part of Britain, and then we said, no, we're not going to do that anymore. We want to be independent. So, this to me, this is a fourth turning, and it's characterized, in my opinion, by the subject of what is money. The monetary system is broken. It's been broken for some time. There's one piece of our economic lives that just doesn't make sense, and that is that we've got 12 people telling us the cost of money, and they can set the cost of money at 0% or they can set it at 20%. And that's just absurd. When they set it at 0%, anybody who's saved, I know retired people who were getting 5% on their CDs, went to 0%, all their income went away. When they set it at 20%, I remember clearly my father was a businessman in the late 70s and 80s. He carried a big inventory. It went up to 20%, almost put him out of business. It's nuts, this Federal Reserve. It's totally nuts. So, but we're getting to the point, the contractions are getting, more rapid, and the contractions are getting larger, because the COVID response was bigger than the GFC response. And so, eventually we're going to have a baby here, and that baby is we're going to have a new system based on sound money, in my view.
You made me think of Condoleezza Rice back in like 2001 when she said these are merely birth pangs.
Yeah, right. Let's go start a war and call it a birth pang, right?
Maybe that's when it started. Yes, it does seem like the baby's coming soon. Larry, Trump Vice President running mate J.D. Vance back in April stated in an interview that he's not against devaluing the U.S. dollar, as it would make it easier to reignite manufacturing here in the States. If Trump and Vance win, is that exactly what you're expecting to happen, a devaluation of the dollar? And if so, what do you see as the impact on commodities and metals?
Yeah, I do expect that. They've said it, and I think we should believe them. Trump has said it. Trump has said he wants to put in significant tariffs. Look, the strong dollar, and probably the best person on Twitter, I'm sure you follow him and others do as well, is Luke Gromen. The strong dollar policy of the United States, has really benefited bondholders, equity holders, and financial elites, and it's literally screwed, the working man and the middle class, because all our export industries picked up and went overseas. And so, you're in West Virginia. I know you kind of look at how I was originally from Ann Arbor, Michigan. The Midwest has been hollowed out, since we let China into, the World Trade Organization. So, it's time, and even Janet, it's even at the insider level, this is even happening where, Janet Yellen made a comment recently where she said something along the lines of, if somebody wants to send us cheap things, from overseas, we'll send you a thank you note. And remember that? And now, and then she came back and said, she's now realized, what, maybe I'm not going to do that anymore, because they've come to realize what Say's law is. If you're not producing, you can't consume. So, it's yes, it's long overdue that we try to balance the world monetary system, in a more fair manner. But it's happening. It's not just happening because of changed policies, and it won't be just Trump and Vance. It's happening because of what the BRICS are doing, and because of what the price of the metals are doing, and because people are net settling in gold. And I'm sure we'll get into all that. But yes, I view it as generally speaking a net positive. I don't know enough about Vance to fully comment on him. I have a generally positive view, although I worry about his warmongering regarding Iran. I'm very much anti-war.
I'm with you on that. You were talking about a more equitable, more fair system. What would happen to asset prices everywhere if free market capitalism was actually allowed to happen instead of the financial engineering that has occurred through artificially low interest rates for more than a decade, QE and other Fed printing programs, and the massive deficit spending we've been seeing?
Yeah, well, it's hard to know with exact certainty what will happen, but directionally, as Groman likes to say, gold and silver the prices won't even be in the same zip code. As you and I both know, the gold and silver prices have been suppressed in order to create this financialization through derivatives and other means. JP Morgan paid $900 million of fines over this issue. If let free, and I believe they're in the process of that occurring, I fully expect we're going to see a $5,000, $10,000, $15,000 gold price on this cycle. Which I know probably sounds incredible and hard to believe. And, I've been saying this for some time, so a lot of people think, oh, you're full of shit. But, be careful because, in the last cycle, the last gold run, as you know, from 2000 to 2011, we went from 250 to, 1900. And so we started this cycle at a base of 1,000. So that was 7X. So I think $5,000 to $10,000 gold is kind of falling off a log on this cycle. So in a free market environment, assets that cannot be printed, gold will be priced much higher. I also think in a free market environment, the bond market is going to really suffer. I mean, the bond market is the sucker at the table. I mean, anyone, you look at Trump's economic policies. I was just reading them before we started recording this. I mean, there's just no way we're not going to have a lot of inflation in the next 10 years, no matter who's president.
Right.
And that's because of the fiscal policies that they're pursuing.
So I do want to get more detailed into gold and the bond market down the road here in our discussion. Okay. But I do want to ask you, here we see gold printing new highs. It did a couple months ago, took a pause. Now it's doing it again.
Yeah.
But yet investors still don't seem to care. What's the number that they're going to be like, oh my gosh, look at what's happening with gold. I need to get in before I miss
this.
You
tell me. I mean, some investors care. I mean, the Asians care. They're buying it. And I know some of the Costco buyers care. They've been selling a lot of bars. You probably saw that article. But you're right. I mean, the ETFs volumes are going down. That some of that could be people getting out of the fake ETFs and going to the real ones. That Sprott runs.
I think we're going to see a big number before this thing starts moving, and then once they get in, it's going to pop hard.
Yeah, I think probably 3,000 is going to wake people up. I mean, what I'm seeing right now is what really happens often in the beginning of bull markets, which is you're climbing a wall of worry, and everyone's saying, oh yeah, it's 24, 25, but we're going back to 2000. We all know that you're going back to 2000, and you see this. I mean, Ronnie Stofferle did a great chart that he put up on Twitter where he showed the Bloomberg consensus estimate. Like 4 or 5 years out, the average Bloomberg analyst was saying gold's going to 1,900. I mean, there's just no way.
Especially with inflation, it's just not possible.
Yeah, there's just absolutely no way. By the way, if it does go to 1,900, a lot of the mines are going to shut down because the costs continue.
That's what I mean. Yeah.
Yeah, the ASICs are going up at 11% a year. So. Yeah. But I don't know, Gary. I mean, I think probably 3,000 will be a wake-up call. I mean, breaking through 2070 was clearly a breakout. Mm-hmm. And right now, the tone I hear in the market is, oh, yeah, but, I mean, there's still a part of the market that's backward-looking that actually believes the Fed will be successful at getting inflation down to 2% and that the 40-year deflationary trend that we have will return. And I understand that. I mean, human beings tend to look backwards and tend to extrapolate the past into the future. And it was a very long deflationary trend. I mean, anybody who's been in the stock market since 2008 hasn't really even seen a bear market, right? I mean, it's, we've had are corrections that were by the dip moments.
Right.
So, and I'm here to tell you, because I've been in the market since the 70s, bear markets do occur.
Recency bias is a very strong, powerful thing.
Exactly.
Well, Larry, there was a report the other day that the Biden administration was going to implement rent controls in an attempt to curb housing inflation. They would cap the rents at 5%. Do you see this as a precursor to 1970s style price controls coming due to the debt and inflationary impacts that we're experiencing and will continue? Or do you think that under a second Trump term, that will not take place?
Well, okay, there are two questions there. I mean, first of all, imposing rent controls, in my opinion, is illegal, and this Supreme Court would overturn it. But having said that, forgiving student debt was illegal, and the Supreme Court ruled as such, and he's still managing to forgive student debt. So I'm not quite sure how that works.
I agree.
It's a stupid policy, and as the 70s showed, when I remember the win buttons that President Ford passed out, these controls don't work. I mean, the only way they worked was like in World War II, where they had, coupons and rationing. I mean, in that, and we were fighting a war and everybody agreed that, we had to conserve on things. But, price controls just don't work, period. And there's no way that Trump is going to put in price controls. Now, he may put in tariffs, which will be inflationary, but a 5% cap on rents, no, that's gone. And I don't think, my reading of the political tea leaves is there's just no way Biden's president, next year. I mean, he's going to lose, and I suspect whoever replaces, if they decide to replace him, I suspect that person's going to lose too.
So Japan seems to be on the verge of a fire sale of hundreds of billions of dollars of U.S. Treasury debt to plug some gaping holes in their teetering banks and pension funds. The Biden administration's been running close to $3 trillion fiscal deficits. What would happen to the Treasury market if Japan actually does sell billions, or who knows, hundreds of billions of bonds, and what knock-on effects would there be?
Yeah, that's a great question, and a really pregnant one, because the Japanese yen, as you know, has been sliding very consistently this year and has broken a critical level, which is 160 yen to the dollar. Um, Look, I mean, they've got a real problem, and they've got more debt to GDP than we do. They've been able to pull it off because their trade balance, they have a positive trade balance. They export more than they import, and they're also a nation of savers. But even that has a limit. And they're starting to see real inflation as a result of the yen being weak, and they import a lot of oil, and they're going to have to figure out how to pay for that. And I suspect that there's been some talk that what they're working on probably is a yen for oil trade, where the Middle Eastern oil producers can net settle in gold. The bond market, the U.S. bond market, in my view, is the absolute most important thing for anybody to have their eyes on. If we do what Britain did in the fall of 22, when the gilt yields blew out because Liz Truss said she was going to cut taxes and increase spending. If that happens here with the U.S. bond market, we're minutes away from what I believe would be a Powell action to go into a yield curve control environment where they decide they have to buy it. Because we kind of saw this last fall when the bond market went from, the 10-year went from the high threes to over 5 very quickly, if you'll recall. And what happened when that happened is, 10 Fed speakers came out within, days saying, no, we're done raising rates. The bond market's doing it for us. We're good. And the bond market quickly, they jawboned it. The bond market quickly backed off. And so what we're seeing, I believe, is that's kind of the critical variable to watch, is because the bond market is the sucker at the table. So we got to ask ourselves, when they start to get nervous, I mean, the U.S. already is in a fiscal dominance position and in a debt doom loop based on $1.2 trillion of interest expense, and a $2 trillion deficit. And that's with an average interest rate, Gary, of 3.2%. That's, all the debt outstanding. That's the average coupon. Right now, the treasury curve is between 4 and 5.5. And a lot of it's getting done at the short end, which is up in the 5s. And so, if as it rolls over, as we talked pre-show, there's $9 trillion that will roll over in the next few years. If that comes due and they have to put it out at 5 instead of 3, that interest expense number is not going to be 1.2 trillion. It's going to be 1.7 trillion. And the point is, and then of course, how do they finance that? They sell more bonds. Well, they sell bonds into a market where they're having trouble selling bonds, so rates go higher. And I mean, this is classic sovereign debt crisis, emerging market kind of stuff. This has happened in other places before. It's happened in Zimbabwe. It's happened in Venezuela. It's happened in Argentina. It's happened hundreds of times. It just has never happened with the world's reserve currency, and the largest country in the world with all the military might. But you know what? It could happen.
What do you see? What do you see them doing to ensure continuity and that doesn't take place?
Well, I think that they will create programs subtly and quietly. I mean, Janet Yellen has already said she's buying off-the-run long treasuries, so they're probably doing some of that. We know they do things off the books through the Cayman Islands because we've seen it in the gold and silver markets, so they're probably doing some of that. But, my thesis, Gary, is that at some point, some big rivet's going to pop. I mean, maybe commercial real estate's going to become a problem, and the regional banks, more than just Silicon Valley, are going to start to fail. And they're going to have to go to yield curve control. They're going to have to say, and it's what I call the big print. They're going to have to say, you know what? We're not letting those rates go any higher, for safety of the country reasons. As the Federal Reserve, we're capping the yields at this level, and we will buy whatever needs to be bought. And of course, what will happen then, in my opinion, is the bond market will say, "Great, Fed, sold to you," and the Fed balance sheet is going to go from $7 trillion to $20 trillion, which is enormously inflationary. And this is how currencies fail. Now, I'm not predicting an outright currency failure immediately, but as I watch the cards get turned over, each one of them is leading in that direction.
Do you think they'll have to go from a strictly fiat currency scenario like we have to more of a hybrid, instead of going back to 40% backing of gold, but maybe to something in order to ensure that there's no demise of the currency?
I do, but my sense is, I mean, they should do it right now before it gets any worse. But as you and I both know, the politicians don't think ahead, and they tend to just respond to what's on their plate at any given point in time. And they've been pretty successful at kicking the can. And usually when faced with a choice, they say, well, I'll kick the can and we'll just print some more money. And sure, it means more inflation later on, but we'll deal with that later.
Yeah.
Well, there might come a point where there's no more kicks left in the can. And at that point, yes, I think we will have to, the current, inflation will be raging. People will be, screaming bloody murder. And some president will come along and say, hey, the problem here is we've got the Federal Reserve that prints money. We've got to restore a sound money standard. And here's how we're going to do it. And I think that will happen. But that's not, sadly, that's not going to happen until there's a lot more pain and there's a lot more political, will calling for that, right? Because right now, most of the world doesn't even understand this is an issue.
Yeah.
Or if they do understand it's an issue, they're kind of in denial. I mean, I find it hilarious that Powell is saying this, these deficits are unsustainable. And I'm kind of like, okay, and
right.
right.
What's the plan?
Yeah, what's the plan? And by the way, dude, you're the guy who's enabling it,
right.
because of your soft money, because of your policies. I mean, it's just, it goes back to that common knowledge problem. I mean, you understand this, I understand this, probably a lot of people listening to this understand this, and people are saying, gosh, this isn't sustainable. The emperor's kind of naked, but we're still, the world hasn't come to that conclusion yet, right? We haven't had the Biden debate moment where it's like, oh my God, this guy's senile.
Yeah.
But the world is good. I mean, that moment is coming, in my opinion, where it's like, oh my God, this currency is programmed to debase. Inflation is going to eat me alive. I got to be in something that's not a dollar, right?
There seems to be an awakening happening little by little in different pockets.
That's right.
I kind of feel like you're right. There will be an awakening on the currency situation as well. Let's talk about the markets for a second here.
Sure.
Larry, there's an S&P 500 trend line that has been drawn that runs from the top of the bubble in 1929 through the 2000 dot-com bubble top, through the 2022 top, and now to the July of 2024 top. Okay, it's now bumping against it. None of the previous times that it hit the line did it stay elevated. In fact, it dropped, and it dropped hard every single time. 2022 wasn't quite as hard, and there's been some forces that mysteriously reversed that drop, and it came roaring back. What do you see for it this time around, as it once again it's bumping against that same trend line that took the markets down hard in 1929 and 2000? Yeah,
so let's talk about two things here. Let's talk about valuations, which are enormously stretched to the upside. I mean, the Buffett indicator, we're more overvalued than we were in 2000 or 2008 wasn't as bad, but let's say in 2000, and coming off of 2000, the S&P fell 50% and the technology fell 80%, right?
Yeah.
I mean, I just did something for one of my newsletters, and I noticed that I checked at the peak of 2000, Cisco was trading at 38 times revenue. Cisco was the leading company at the time, producing routers for the internet. It was a big deal. NVIDIA today is trading at 41 times revenue. It's kind of, things rhyme, right? So valuations are extremely stretched. So that would imply that stock prices should go down. However, let me point out that what's high can become higher. and I'm not, I've been calling for that to happen, and I've been dead ass wrong. And maybe I'll be wrong now too, but we are about to go into a loosening cycle, as Powell has made very clear with his recent comments that he doesn't need to wait for it to get to 2% inflation before he starts to ease. And so the animal spirits that will happen when he eases could drive us even higher. And there's a fairly intelligent analyst that I respect, who originally I disagreed with, but I'm coming to see his point of view, named David Hunter on Twitter, ex-Fidelity Money Manager, who calls for an S&P, and you'll like what he says about the metals. He calls for an S&P 500 of 7,000, and he's calling for a $75 silver, a $3,000 gold. I mean, this is all within a year.
Yeah,
because he thinks we've got one more kick at this can in terms of a run-up in the markets. And you know what? He could be right. I just don't know. I don't think it really matters. What we tell our clients, what I know I feel strongly, is that there's no value in the market and therefore in the regular stock market, and therefore I don't want to be there. So, because it could go higher, sure. Could it fall apart? Sure. But I can't predict which of those two is going to happen, so I don't care. What I do know is that if I look at the stocks I do invest in, which are gold and silver stocks, gold and silver mining stocks, there's a ton of value there. They're selling at 3 times cash flow. Cash flow is growing because the metals prices are growing. They're going to produce more ounces in the future, et cetera, et cetera. So that's my investment theme right now.
So you mentioned the statement that Fed Chair Powell recently stated, if the Fed waits for inflation to get to 2% to cut, it has waited too long.
Correct. Yeah.
So clearly, it's on the mind. They're going to cut at some point.
No doubt.
Now, of course, a lot of people have been predicting for more than a year that they would have cut already. But with the $9 trillion you talked about, that wave coming of maturing debt that's going to need to be rolled over, he's going to be faced with a decision here at some point. Do I keep it up there and really crush the deficit spending even further, or do we get that under control and deal with some inflation? How will this upcoming Fed rate cut that is coming at some point, how will it affect commodities, the precious metals, and the miners, in your opinion?
Well, I think it'll be positive for them because it represents an easing cycle. And if you look at the correction that occurred from the top in 2020 on the metals to present, before we broke through 2070, we were in a tightening cycle. So, in my view, the metals have already, you got to remember the metals look forward. So they've already anticipated and moved on some of that. And ironically, they could cut and the metals could back and fill a little bit. But setting all that aside, look, the Fed Watch site says there's a 90% chance of a cut in September. Some people are saying maybe he'll even do it in July. I don't know, he could. On the other hand, with the stock market doing as well as it's doing, he might say, hey, I haven't seen enough cards to cut. But I think at the end of the day, what you've alluded to, which is the interest rate expense, and the debt rolling over, I think that's going to push him into cutting. And he's going to, you can look at the data and you could say, well, this is bullish or this is bearish. Employment is right at close to the SOM rule, which, when it breaks through, unemployment breaks through a certain level, 50 bips above the trough at the bottom, we're in a recession. I mean, it's a tough call as to whether we're in a recession or entering a recession, at least to most traditional economists. I think we're in one, but, and so they can make an argument either way. My gut is he'll cut. And the reason he'll cut is it helps the government finance the debt. So, the short-term impact on the metals, who the hell knows? But the longer-term impact on the metals is they're going a lot higher,
So let's stay on the inflation theme. One last question here. Today's inflation path really seems to be tracking the inflation path of the 70s over the last several years,
doesn't it? Yeah.
With a very, very high correlation.
Yeah.
If the correlation holds, well, that means that pretty soon, maybe within 6 months, we can expect another significant rise in inflation. This time, it's going to push much higher than that 9.9, that we experienced in 22 and 23. Larry, in your analysis, are you expecting the correlation to hold and for us to see another massive surge in inflation to hit later this year and into 2025 and maybe 26?
I really am. I mean, I do think it's like the 70s. I mean, Tavi Costa's got some great charts on Twitter, that show that. I mean, each wave is a higher low and a higher high. There'll be a lot of cross currents, though, Gary, to be fair. I mean, if the economy is falling apart, that might, bring the prices of some things down. I like to think that what's going on, some of what's going to go on in this particular decade is it's going to be inflation in all the stuff you need. And deflation in the stuff you own. The things that are financed by debt. I mean, I could actually see a case where, food and gasoline are getting more expensive, but housing prices actually fall, because we're in a recession, people have gotten levered up. I don't know. There's so many moving parts. I mean, and as we all know, the numbers aren't really even accurate anyway. I mean, my most recent quarterly net report I'm showing, I mean, you look at healthcare costs, they're going up at like 12% a year. Auto insurance is going up at like 20% a year. I mean, it's, this whole notion that we're really in a 2 or a 4% number, it's not, that's not even real. I mean, go to shadow government statistics, John Williams, and you'll see that. So
wasn't there a quarterly number for health insurance saying or suggesting that it went up like 30-something%?
yeah, I think that's right. I remember seeing that too. Yeah, in the last couple of quarters. I mean, look, it's horrible. It's absolutely horrible what's happening to this country. It's horrible what's happening to the middle class and the lower class of this country. Everybody, I mean, even upper class too. I mean, we all feel the pinch, but the upper class got a little bit more, or, mid to upper middle class has got a little bit more cushion to absorb it,
Especially with the higher interest rates paying on their CDs,
yeah, I
money
mean,
markets.
and certainly the people, I mean, who finance their houses at 3% are feeling pretty good about that. Of course, it's horrible for the young people who are trying to buy a house, and housing prices are high and interest rates are high. And, I know my kids are in their 20s and they're like, I'm never going to be able to afford a house.
Right.
I can certainly see their point of view.
Yeah. Well, Larry, you were talking about the wave of debt that's coming. The U.S. is running these historical fiscal deficits. The massive wave of at least $9 trillion is maturing and coming, needs to be rolled over at much higher costs, unless they dramatically lower rates. But all signs are pointing to them not doing that, at least dramatically. With all that's happening geopolitically and economically around the world, are there even enough buyers for all of this issuance? And if not, doesn't the Fed have no choice but to monetize most of it? And if they do, what happens to the rates and to the dollar? Before we wrap up here and I ask Larry our final question, I want to point everyone over to our Substack. It is free. Go to metalsandminers.substack.com. We post free content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. It's all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, "If You Don't Own Gold, You Know Neither History Nor Economics." This free
I love that quote.
is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive this free gift on us. Also, I'm positive that you've enjoyed this conversation with Larry as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video.